Okay, good afternoon, everybody, and welcome to the first Think Learning webinar. Should be the first of a series of educational and market research related webinars that we'll be hosting for you. My name is Carl Capolingua. I'm the market analyst over here at Think Markets, and today we're going to take a look at travel stocks. But before we do, let's talk about the Think Markets difference, which is substantial. You get $8 standard rate brokerage trades on ASX shares. You get your own holder identification number, and that is really important. Make sure you ask your broker whether you have yours, and unlimited phone support. It is a superior and unique offering for ASX shares. So before you do that next share trade, make sure you think markets. Okay, the agenda for today is to have a look at some of those travel stocks. Unfortunately, it's a half an hour webinar. We won't have time to look at every stock, but we'll certainly look at the main ones. We'll have a look at some of the key macro factors, that is macroeconomic global factors that are impacting the industry, which stocks to look at in that sector, some of their fundamentals, and then we'll finish off by looking at some of the charts. Okay, you couldn't have a conversation about what's going on in the travel sector without talking about the COVID-19 situation. If not for COVID, we wouldn't be having this conversation at all. Now, trying to keep it high level here so we can focus most of our time on the stocks, but there has been talk very recently, in fact, as high as the Prime Minister, that we would like to see some travel bubbles open with Japan has been mentioned, Singapore's certainly been mentioned, Taiwan and South Korea are the main ones. Obviously, there is a one-way travel bubble currently in place for New Zealand. I would suggest that given the current situation in Japan, and we are looking at a 7-day rolling average here, and if I can find my pen, there it is. With over 2,000 cases on average over the last 7 days, that travel bubble will not be opening anytime soon, nor will the one with South Korea. And assuming things stay the same, there is a chance for Taiwan and potentially Singapore. Australia's showing 12.1 cases, but those are mainly returned Australian citizens coming back, and most of those cases, if not all, I would expect are in quarantine. But the Europe number wasn't out on this slide yet, but the one for the previous day at 240,000, and in the US at 173,000, and with very little signs of those curves coming down, maybe flattening out in Europe. I would suggest we are not going to see travel to those countries anytime soon. Okay, so what are the impacts? Clearly, there is, and there has been, a restriction on movement, both in terms of international travel, so across country borders, and within countries themselves, so domestically. To put some numbers to the scope of the impact on this industry, and the world tourism is the third largest export market in the world. 120 million jobs are at risk, and we've seen a 70% decline in global tourism from March to August. Given the situation that we saw in that previous slide, that's probably going to continue for at least the next 6 months until vaccines start to have a material impact on just people getting them, and then on the economy, and then on potentially travel. But I'm thinking at least 6 months of that sort of a decline. In Australia, great news is we've got a much better handle on the situation, and this means that state borders can come down quite quickly. That's already happening as we speak. And potentially this $60.8 billion worth of domestic tourism can come back, and potentially even come back even stronger because of that our inability to travel overseas. To put some perspective on it, and this was a really interesting stat, I didn't know this until I did the research for this presentation, but domestic travel in Australia is 64% of our travel dollar compared to 36% internationally. So that provides, I think, great scope for some of our travel companies, our beaten down travel companies, potentially to come back stronger on this, hopefully, expected surge in domestic travel. Hopefully, we just see a lot of this head over here. That would be nice. And it's important because there are 666,000 jobs at risk in the sector locally. That's approximately 5% of Australia's workforce. And in that sector, we've seen already $21.3 billion worth of lost salaries and wages due to unemployment and underemployment. And that is, that's wages lost for the entire Australian economy as well. So it impacts the broader Australian share market. Okay, so path to recovery now. That's sort of where we are and how we got there. How are we going to get out of this? Well, obviously a vaccine is the key determining factor in how the world recovers from this crisis. How widely is it going to be available? How quickly and how widely can it be distributed? Now, putting all things together, shaking them up and then tipping them out, we've got a chart here from the International Air Transport Association. They're predicting, all things considered, that we potentially won't see a return to pre-pandemic levels until 2024. Now, I note that the latest data I could get on this was 30th of July. Since then, obviously, there's been some amazing, some fantastic developments on a vaccine. So maybe we can see that happen earlier. I do have some research actually post that from Goldman Sachs, which is predicting towards the end of 2023. But order of magnitude, 2023, 2024 is a return to normal, and it will largely be dependent on the data on this slide. So this is what's happening with the vaccines at the moment. Plenty of news on this lately, and it's been in the media, so I won't focus too much on this, but mostly I think the last two columns are probably the important ones for the travel sector. So we're talking about distribution, the ease of distribution, and then we're talking about the scale of distributional production. In terms of ease of distribution, the first vaccine that we came out that was shown to be quite effective was the Pfizer BioNTech one. And that 15 days at -70, I think, is a major problem, as is the 5 days at normal refrigeration temperatures. 650 million doses expected by the end of 2021. We had some great news from Moderna that their solution is 6 months at -20, far easier to achieve. My fridge at home can get that cold, so that's good news. And then 30 days at normal refrigeration temperatures, 780 million doses. And by far and away, the big one is this one here, 6 months at normal refrigeration temperatures. And these guys think that they can produce 3 billion, that's with a B, 3 billion doses by the end of 2021. Now, this says up to 90% effective, and that's because there were two parts of this study. And the 90% effective came from when you took the half dose, and then 28 days later, you took the full dose. So it wouldn't make any sense. The other group was 60% effective. It wouldn't make any sense why you wouldn't just use that technique there. So I think we can stick with that for the time being. The rest are much of a muchness. I don't know if I was offered this one, whether I would take it. That's Sputnik 5, the Russian variation. Okay, so travel bubbles, are they going to happen? I don't think it's as important because I think the pivot to domestic will probably play a bigger factor, at least in the short term. We do have one with New Zealand, but I'm just noting here that it's very, very small, and there was a big question mark over the other ones, but probably not till H221. And in H221, if it does occur, we're going to see things like this. So vaccine transport. So do you have a passport that says, and it'll be separate to your standard passport, but passport that says, yes, I have been vaccinated. This is when I was vaccinated. We'll obviously need to improve airport technology. It's pretty good at the moment, but testing at airports, et cetera, and in the news during the week, there was even talk about putting those ankle bracelets on people coming into the country to keep track of them. I'm sure there'll be an app for that. So it is possible, but it's still a ways down the track. I think this is far more important, this international to domestic pivot. So how good can this be for our travel companies? Well, I think it can be pretty good. I mean, if you look at this survey here, and this is from Tourism Australia, 77% of us said that we'll switch at least one of our overseas holidays to a domestic holiday, compared to prior to the pandemic, and 66%, two-thirds, said we'd switch all of our overseas holidays. I think as this drags out and as we start to realise that international travel is not coming back, probably until deep into that second half of 2021, that may even improve. So where are we in terms of the state borders? Pretty good and getting better. So by December 1, we should have fairly free movement between all of the states, except for people from Victoria who will continue to have to quarantine. The big exception is my home state over there in WA. We call it Fortress WA. There is a state election over here early next year, and the sitting premier has become quite popular for maintaining that stance. So I think WA will loosen its borders, but it might be an after Christmas one, whereas Victoria might be other states for Victoria might be a before Christmas one. But, come back in the recording. The recording of this presentation will be put up to the website, and you can pause and have a look at that more closely. But in summary, we are going to have the ability to travel within Australia, I think, very, very soon. Okay. That's sort of global macro factors. Let's bring it back to stocks now and then spend the rest of the presentation talking about stocks. the path to recovery for some of these travel stocks. Almost overnight, many of these stocks saw revenues decline by order of magnitude 90 to 95%. And it is shocking, once in 100 years, whatever you want to call it, but it became their reality. So what do you do as management? How do you handle this? Revenues almost dried up. Well, first thing you need to do is cut costs. You need to try and get cash flow positive. You need to get your costs back to your revenues. Now, if your revenues are down 90%, that would require you to make some pretty deep cost-cutting measures. Qantas, $15 billion with a B again. That's a significant number. Flight Centre, we're targeting 70% cost reduction. Sydney Airports, 35%. I'm just using these three as a case study. So cut costs first. Now, in many cases, you shut down your revenue centres, and that's a problem. So it's easy for Flight Centre to say, we're going to target 70% costs. Well, we just shut down a bunch of stores, but they were revenue centres. So you want to switch those back on at some stage, and you may not be able to. Maybe you've lost that lease with the shopping centre. You can't get the staff back. That there are problems with shutting down those revenue bases. Okay. The next thing you need to do is, well, if you can't get cash flow positive, you're going to be burning cash. But burning cash, we mean that your expenses are greater than your revenues. Month by month by month, it's chipping away at your savings. It can happen to any of us, individuals. Of course, if you lose income, you've got to cut costs, or you're going to dip into your savings. Now, savings for companies is cash at bank or cash equivalents, and they like to hold a lot of these companies a few $100 million of cash. If they start to feel that cash is going to be at risk, and don't forget, back in April, even to August, September, we didn't know how long this was going to last. If they start to feel that cash is going to dip into the negative, then they will start to raise cash. They'll probably, to be fair, they wanted to do it anyway, just in case. Qantas, $1.4 billion issued at $3.65 a share. The quickest way to do it is to just issue shares. You just pump out more shares, because the alternative is to raise debt. And for that, you need somebody to trust you that you're going to pay that you are going to pay them back. And I don't think there was a lot of trust for the industry back when things were terrible. So quickest, easiest, surefire, bang, get shareholders to pay for this. So 1.4 plus another 500 million in August for Qantas. But if you took up that offer, you're way ahead right now. If you took up the offer from Flight Centre, you're over double your money. 700 million there, plus a 400 million convertible notes issue in Sydney Airports, raised 2 billion, the biggest of really any of these travel companies. And I'll explain why when I get to pivot. So your next strategy is to find other ways to make money, to bolster that revenue line again. So obviously Qantas has this amazing frequent flyer program. In their freight business, we saw their freight volumes pick up significantly because of COVID. So yes, obviously they'd rather not have had the COVID situation happen, but people are at home, they're ordering online, freight business goes through the roof. That's been brilliant. And the frequent flyer program, when people are spending, they want to get those miles on their frequent flyer program, because they want to use it to purchase travel down the track when you can start to travel. So that has actually kept Qantas cash flow positive, and that I think is really, really important. Flight Centre chosen to focus more on their online sales channels, and as has Webjet as well, and they're seeing some great success there. Obviously, mainly towards domestic travel, as bricks and mortar locations are closed. Sydney Airports, I deliberately put this one in because there's a question mark there. There is very little Sydney Airport can do to pivot. They just have to ride it out, and that's why I believe they raised more capital than anybody else. So it gives them that flexibility to ride it out. Just very quickly before I get into the individual stocks, and it'll come up as we go. The other reason why you want to raise capital is to purchase distressed assets. So when there is such a major impact on the industry like this, some companies aren't going to make it. So if you've got a strong balance sheet, you've got cash there, you can take advantage of some of those distressed assets and get businesses on the cheap. Let's have a look at Qantas first up. We've discussed many of these things already, so just very quickly here, and this is from their FY20 results. Obviously, step number one, cut costs. Step number two, pay down debt. That's really important as well, because if you pay down debt, you've got lower interest rate costs going forward, and you can then you can use that strong balance sheet that you've got to make those acquisitions we've talked about. They have remained cash flow positive, but clearly a focus for management, and the rest of it is all sort of management stuff about how we're doing so well managing through the crisis. This is more important. So order of magnitude of the impact on Qantas. So we've gone from 3 million odd passengers on a rolling basis per month down to zero effectively on domestic, and an even bigger hit for obvious reasons on international. This is the Goldman Sachs chart I told you about earlier on. So they're looking at sort of mid-2023. Get that out, Carl. Mid-2023 to get anywhere close to back to normal. But Qantas is very well placed, to be fair, very well placed to ride this out. Plenty of cash. They've got the support from the frequent flyer and the freight business. They are, in my opinion, number one to ride this out. Number two is corporate travel, and they're actually doing pretty well also in terms of positioning themselves. They have also done a large capital raising to shore up the balance sheet. They still managed to eke out a profit for FY21. They are geographically diverse, so I think for these guys, they will be able to take advantage of increased domestic travel amongst different countries. Obviously not cross-border, but within those countries as well. So you can see Australia, New Zealand, Europe, USA, Asia. They are in a strong cash position. As I said, to ride it out, they are in a cash burn, so they're not cash flow positive at this stage. Moving on to the next one, we'll get to some more fundamentals and numbers later on, but just a quick look at where they are. Flight Centre, these are, in my opinion, in order of ability to ride this out. Still pretty well placed, to be fair, but in comparison to the others, you're looking at 90 to 95% reductions in many of their centres. Good news here, their corporate doing well. I guess the other bonus is that they've got that as well. So the virus situation largely in hand in China as well. So there's still revenue coming in. That's the good news, and they have taken the right steps in terms of firming up the balance sheet. They, much like all of these companies, I'll just say it now, that all of these companies have cut their dividends and have said there will be no dividends for the foreseeable future. I think that's important to note as well. The corporate business is doing better than expected, I've got here in my notes. Given the fixed cost base, they require about 30% of normal to get back to break even. Currently tracking along at about 15 to 20% of normal, and they need to get to 30% to break even. This is the same sort of theme here with Webjet. So they need 23% of previous to break even, and they're currently at 15, and the trend is heading up. Okay, so once we get to break even, I think these companies will have a big sigh of relief. Good news for Webjet is they're taking advantage of this move towards online travel bookings. So almost really at Flight Centre's expense, really, Flight Centre with the bricks and mortar stores, and Webjet have seen a big jump in their online sales. So that puts them in a pretty good position going forward. Hello World, finally, just looking here at the light blue lines, 2020 versus the dark blue lines. And just looking at the incredible impact here. So these guys have a larger exposure to cruise, and you might say it's crazy, but they've actually just made a big acquisition on that side of things in terms of Cruise Co. But they are again raising capital and trying to position themselves for potential growth after we come out of this. Sydney Airports is one I probably could have lumped in there as well, but they have the least ability to pivot and to improve their earnings until passengers start flowing through the doors. In terms of when that might happen, this is the experience that we've seen in some of the other countries around the world that have seen rebounds in domestic travel. We're seeing parts of Asia returning to or exceeding pre-COVID levels. And that is giving us potentially an insight into what we can do. They had fewer intra-country border closures than we did, so we're down here. So if we can get up to here at 123%, so higher than pre-pandemic levels, consider what that might mean for the travel industry going forward. So the precedent, I guess, is already there. We'll have a look at some more fundamentals in a second, but just having a look at some of these other stocks. We'll have a look at the charts of these, but clearly, given we're 20 minutes in, we won't have time to look at the fundamentals. But Sydney Airports, Auckland Airports, Ardent Leisure, Crown, Event Cinemas, Star Entertainment are all other companies which, to be fair, are worth having a close look at, seeing if there's any potential there. Shopping centres, major impact, and toll roads as well, and Transurban and Atlas Arteria. As I said, we'll have a look at some of the fundamentals for the key stocks we're looking at today. So Qantas, and we're looking at what the brokers are saying about it and then some of their numbers going forward. So we've got an average rating of a buy for Qantas, 3 strong buys, 5 buys, 2 holds, and just the 1 sell. In terms of their mean estimate, about 478. So that's a little concerning for me, given that the current price is at 557. So brokers are saying buy, but their price targets are, whilst there is a range between 590 and 3, the price targets are showing an average of 478. So the stock has moved faster than a lot of these brokers were expecting, is what I'd say there. In terms of their numbers, we can see some revenue numbers here for 19, 20, and then expectations for 21, 22, and 23. So these are Thomson Reuters numbers, and they base these on a survey of basically all of these brokers here. And the brokers, everything from Macquarie Bank, UBS, Credit Suisse, Deutsche Bank, Morgan Stanley, Citigroup, and so on and so forth. Okay. So again, we're looking at an FY23 return close to normal, and 51 cents a share is pretty close to the 56 cents a share it earned prior to the crisis. But interestingly, they're not expecting the dividends to pick up anytime soon. So the dividends, even though we may get back to the same earnings, the dividends might still be as little as half of what they're paying before the crisis. In terms of their PE ratio, what are you paying now for those future earnings? Well, if you believe that the brokers are going to be right, the stock is not particularly expensive at this stage with a PE of around about 10.8. But I do note historically that's a little high for Qantas because it's typically around about 10. Okay, so again, getting back to this idea here that maybe the run that we've seen has factored in a lot of the upturn already, and that's, I think, is the main problem with travel stocks at this point in time. So I guess if you're listening, you want to know whether I should buy, hold, or sell. And when we get to the charts, I'll explain that more. But I think they have had a pretty good run, given that between we're here, right? Given how much can go wrong between now and then, so potentially a lot of this recovery has been priced in. Okay, let's look at the next one. This is CTD now. I know I'm covering the logo there, but corporate travel management. Brokers are a buy. We've got 1 strong buy, 7 buys, 1 hold, 1 strong sell. In terms of the price, we're at 26 with a mean broker target of 17.74, just again showing how fast these stocks have run ahead of what the brokers were thinking. Now, brokers can upgrade those price targets as well, don't forget. Where are we in terms of revenues? You can see the impact here on earnings before interest and tax really coming down here. And then the hope is, again, by FY23, we've actually potentially exceeded. So that's more impressive than Qantas. In terms of what you're paying now for that future growth, you're at 21. So typically we say anything over 20 is considered to be starting to get expensive unless you've got the growth to back it up. It's frightening when you look at what you're paying on the current earnings as well. So again, some of these stocks have had a very good move up until this point. Okay, Flight Centre, how's that tracking along? Brokers not as positive on this one. They're at a hold. We've got 2 strong buys, 3 buys, 6 holds, 2 sells. We're almost exactly at the broker's target at this point in time. We're looking at, again, in 2023, not quite getting back to where we were in 2019. So slower path to recovery there, and you're paying close to 20 times the earnings for FY23. Having a look at Webjet, I'm just noting the time here, we're getting close. We're a hold there. And again, FY23, you're paying 20 times earnings. So if you're looking for cheap stocks here, it's not happening. So I think the message, we've got an average of a buy for Hello World. Again, by 2023, not quite back to pre-pandemic levels, and you're looking at about 15 on the PE. Okay, so this is just for you to come back and pause. You can just look at them all across the board there, pause, and you can compare and contrast the fundamentals. Okay, over to the charts. So these are the standard charts that I use in Think Technical. If you're wondering what the indicators are, we have the 21 and 34 exponential moving averages, which indicate our short-term trend, And then we have our 144 and 233 exponential moving averages indicating our long-term trend. It's just a style issue. This is the way I like to do things. This is not official Think Markets technical analysis. Okay, this is my own personal way of doing things. I like to see a short-term uptrend if I'm going along. I like to see a long-term uptrend if I'm going along. That is buying a stock. I don't mind buying a stock if the long-term uptrend hasn't yet turned up, assuming the short-term uptrend is up, but on the anticipation that it will. We can see these moving averages getting close together, and potentially they can cross up much like they did here, and also potentially they can cross down much as they did here. So you can see the change between the long-term uptrend and then the long-term downtrend beginning through the ribbon, the darker ribbon there. What I do like to see for turnaround plays, now clearly this is not a bottom left, top right sort of affair. Maybe Qantas, kind of there. If I go back, bottom left, top right, a nice uptrend, everything's looking good there. Of course, then COVID hit. So don't hold that against the chart. It took COVID to kill that trend. But without that key long-term trend in place, what I'm looking for is how we've performed against the long-term trend of the past. And I know that's not showing up too well, but you can see that these zones tend to push the prices down. So I want to see us get above the zone. So we're interacting with the zone. I want to see us get above the zone. And then what I like to see is a pullback and then the next move up. And that's typically where I like to catch these. Now, the announcement of the vaccines have completely ruined any chance of doing that. Certainly I was watching Qantas very closely in here. And then the vaccine hit and bang, off we go. Okay, that's history. What do we do with it now? Well, in terms of where it can get to, we start to look up to potential resistance levels, and I'm just drawing off a few key ones here. So I'm looking at key turning points from the past. They tend to act as key turning points going forward. And we could see an upside of 620. Does that mean you go and buy it here? Not for me. As I said, I like to buy things in uptrends on pullbacks, and we're not seeing that. So whilst I think if you had Qantas, you would certainly hold into that 620 level, if you're looking to buy it, it's not one for me right now. I'm going to look elsewhere around the market for stocks that are meeting my technical criteria. Corporate Traveller, this is actually a textbook now, isn't it, of what I talked about before. So you can see how they bounce down these long-term zones offering resistance, and then when you go forward, they tend to offer support. So that theory of previous resistance acting as support. And this is exactly what we wanted to see. Again, before I can do anything about it in our Think Technical section, the vaccines have hit and we've gone up above my buy level. I'd be looking at potentially in the very short term 22 as a key resistance point here. And I think unless you're on it, you've kind of missed the move, which is a little bit of a theme for some of these. Interestingly, Flight Centre, we're looking at how it's interacting here. It's in the zone. Didn't quite hit the zone here. The moving averages have started to converge, which is a good sign. But unlike the first two we looked at, we're not above them yet. So Flight Centre for me is a wait and hold. It's not one necessarily that I'm looking at until we can, again, get above that line, come back and test it. And that could be a few dollars away. And you might say, Carl, why don't you just go buy it here? Because by the time it's gone up a few dollars and you've got your buy signal, I've missed out on the gains. Well, we don't know if it's going to get there yet. So for me, technical analysis is buying things that are in established or establishing uptrends because that reduces your risk. So potentially there's a greater reward here, but I think also greater risk because we've seen before that when the prices come into this zone, they can get pushed back down, and Flight Centre is really only just interacting with this zone. I think it's doing a pretty good job in here, to be fair. It's hardly hitting that zone and coming straight back down, but it's still too early for me on Flight Centre. Webjet, this is one that's broken through the zone, so now Webjet is actually fairly simple for me. I just want to see how it responds here, and I like to buy things on pullbacks in emerging uptrends. And therefore, if it can get back to 550, and now the market's so positive right now, it's frustrating that's a little harder to do, but that's where I'd be looking for Webjet. I do know we'll probably see some resistance in there, but there's still plenty of upside. Hello World, again, this is one which potentially can come back and test that level again and move off. Again, you can see why we don't necessarily want to go too early, because often when they hit these zones, they come back down. So definitely on watch, Hello World. Would I be buying it here? No, I think it's had a good run, and I can't control necessarily what the market's doing when these webinars occur. So, it's just a function of what's already happened. I wish I could rewind a few weeks on some of these and give you better levels, but it is what it is. This is one which I do like. It is one we have featured in Think Technical, and for all the reasons we've talked about. So it's gone up, it's pulled back, and it's moving. And I'm pretty sure we featured in thick technical back here, but I don't think it's too late on this one. It's moving pretty well. We're seeing the short-term uptrend, the long-term trend hopefully will establish, but that test is good. So I think Ardent Leisure is, for me, the first buy that I've seen so far. Crown, there's a few to get through here, and I think I've established some of my rationales. So this one is more of a wait and see until we see how it does, getting above that long-term downtrend. Event, this one looks very good. So this is one which I would actually be looking to buy right now for all the reasons we've discussed. The Star Entertainment Group is one I have covered in Think Technical, 357, so it's ahead of that now. This is one I'd be looking to buy right now. Sydney Airports, I'd be looking for a pullback into the 640 zone and to see how it responds there. Auckland Airports, this is one I have featured in Think Technical. This is one I'd be happy to buy right now. Centre Group, this is actually looking pretty constructive right here. Maybe it's worth just watching this one for a little bit of a pullback into 270, 260, but I'd be looking at it very, very closely there. Otherwise, it looks quite interesting here. It's above the zone. This one looks quite interesting as well, Vicinity Centres. It's sort of interacting with the zone. I think maybe it's too early to be involved in this, and I think some of the other ones we've seen are looking more prospective, so it's a pass for me. Stockland Group, this is one I haven't featured in Think Technical, but it is meeting the criteria. I just don't think it looks as exciting as some of the other ones at the moment, just pulling back a little bit. Maybe the momentum isn't quite there. But otherwise, if you had it, I would certainly hold it in terms of buying it. I think some of the other ones we've talked about are looking more interesting. And you should know my philosophy on this one right now. It's too early as far as I'm concerned, and I might be wrong. It might be at $8 in 3 months, but I'm about seeing those uptrends emerge before I get involved. TCL, that just looks a little bit too flat for me, but I do note it is in a better technical picture than many of the other ones we've seen. It's half interesting here at 1450, but given this overall is quite flat, I'm less interested in it as a turnaround play because it's not really much of a turnaround sort of chart, is it? And the final one is Atlas Arteria, which looks pretty interesting here, but I would lump it in TCL. I think there are better ones out there, but with it having gotten above that long-term downtrend zone and testing, it does look quite interesting. So $7 potentially we could see it move. There's going to be some resistance here and then here. So I don't mind that one. I would certainly hold it, but if I would buy it, it's probably a no based on the fact that I think there are better opportunities than the ones we've discussed. Okay, well, we've gone a little bit over time, so I might end it there. Don't panic. We can talk about this next week because in next week's webinar, it's an Ask the Expert. So that's this one down here on the 2nd of December. And you can ask me anything you like. So I'll be online, but we'll have some other people from Think Markets online that you can ask about the Think Trader app or your account or whatever it is that you want to get those questions answered. So tune in there and we can talk more about these travel stocks. We'll have half an hour to do so. That is it for me today. However, hopefully there was some interesting information in today's presentations and you got some ideas on what to do with some of those travel stocks. You can catch all of my analysis and more in the market news section of the website. The web address is there. You can follow me on Twitter or the Think Markets handle if you like. I'll be back on Monday on the 30th of November for our weekly Think Tank, which is a wrap of what will be this week and then a look ahead to next week. Apart from that, very important we talk about the disclaimer. Don't forget, Think Markets is a regulated Australian broker. We do have some products that could see you lose more than your deposit. So before acting upon any of the general advice in this presentation, you should consider that. Or give us a call or check the website for more details. That's it for me today. Hopefully you enjoyed the presentation. All the best if you're trading. Until we catch up again. Bye-bye for now.